Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in with us, make sure to hit that subscribe button both on YouTube and the podcast side of things. That helps spread the word of everything we are doing here. In today's podcast, we're going to be talking a little bit about, if I could find it, I tweeted last week a lecture that Buffett gave to Notre Dame about Disney. Let me scroll down if I can find it. When I was adding everything from your old blog to the free content section.
That's a great transcript if you can find it online.
It is. And here we go, right here. Somebody else tweeted this too after me, and they totally didn't give me credit for it, which is fine. It's not our source of content, but I'm like, this thing was from 1991, and I happened to just tweet this, and then
that's all right.
It goes both ways.
I'm trying to remember. Was it Tilson or something?
It is
in the first thing. Okay,
it is Whitney Tilson.
There you go. So give credit to Whitney Tilson.
Good job, Whitney Tilson. Okay, so I have it right here.
Or he's going to say the same thing that you just said.
Yeah, I know. I'm a hypocrite. Okay, let's see. Okay, perfect. So he was talking about Disney and investing in Disney.
Buffett.
Yeah. And about how in 1966, when he originally invested in the company and what that process was like. I thought it was really interesting. So we're going to talk a little bit about this right now. So he says he was talking about his philosophy. It's a really great document. As you can see on the screen right now, there's 48 pages. So I'm going to put the link in the description and you can go and read it yourself.
Yeah, it's one of the best Buffett lectures, Q&As, whatever that I've ever seen.
That no one ever references either, by the way.
I mean, I have a copy of it and I read it, but yeah. So if you get your hands on it, get a copy to keep for yourself because it is one of the best.
Mm-hmm. Yeah. So he was talking about the 20 punch card philosophy. Mm-hmm. If you only have 20 investments to make for the rest of your life, you'll think very hardly about the investment that you're about to make yourself today. And he goes through talk about, so he's like, so when we find something we understand, if we're buying all the business, I want to like the people. If we're buying part of the business, that's less important. We want to buy things we understand and we want to buy them very cheap. If we don't understand them, we don't buy them. If they're not cheap, we don't buy them. If we could buy them with Tom Murphy, my friend, at an attractive price, we do that in a second. And then he goes on to talk about Disney. He said, we bought 5% of the Walt Disney Company in 1966. It cost us $4 million. $80 million was the valuation of the whole thing. 300 and some acres in Anaheim. The Pirates ride had just been put in. It cost $17 million. The whole company was selling for $80 million in the market. Mary Poppins had just come out. Mary Poppins made about $30 million that year. And 7 years later, you're going to show it to the kids the same age. It's like having an oil well where all the oil seeps back in. So we kind of walked through like the process of buying into Disney. So it was selling in the market for $80 million. Mary Poppins that year made about $30 million itself. So we kind of went through how we thought through the valuation. But basically, he's talking about how this was a no-brainer. So he goes on, he says, I went out to see Walt Disney. He had never heard of me at the time. I was 35 years old. We sat down and he told me the whole plan for the company. He couldn't have been a nicer guy. It was a joke. If he'd gone to some huge venture capitalist or some major American corporation, if he'd been a private company and I said, I want to buy into this is a deal, they would have bought in based on a valuation of $300 or $400 million. So that's the most interesting part to me about this, right? So he's not even like being precise with it. He's not doing like a DCF. Right. He's not doing any sort of complicated models. He looked at it as, okay, so you have this great brand. Or people want to go to it. They like watching Mary Poppins. And by the way, that library is worth something to future generations. It's selling in the market today at $80 million. We could buy up a portion of the company. And I think if this was a private business, the valuation would be $300 to $400 million. I don't know what the exact value is, but it's kind of like what he always says. You don't need to know the weight of somebody to know that they're fat. He's approximating through the whole process. So I'm kind of curious to hear your thoughts on that, the way he thinks about that. And do you think that is like the right way to think about it? Because it's like, I've never seen you do a DCF on any company that we own. I know we did it one time when we did work on Howard Hughes Corporation like 4 years ago. Mm-hmm. But why did we do it then versus like how you typically think about it today?
Well, that's a check on sort of whether your estimates are reasonable. So Howard Hughes and some things like that do have this problem where they have significant assets that might take a long time to be realized. You have the same thing with Maryland and Pineapple. You have the same thing with U.S. Lime or something like that, you have to ask, okay, if something has reserves to be selling land or to be selling lime or whatever for half a century, how different is that from if it, had sold what it could for 5 years and then has that remainder left over? That how much of that remainder, those later years thing, how much do they matter? And so you have to do a DCF for that to kind of test whether it's valuable or not. Other than that, we don't really do DCFs.
Mm-hmm.
Yeah.
I just think it's interesting because, a lot of people were talking about the 10-year and like what you should use in your DCFs. And we had a question in the last podcast about how interest rates affect the value of your investing and stuff like that.
Yeah.
It's like through this situation, he just laid out this roadmap and it talked nothing about it. It was just very simple of, it was in the market at $80 million. They earned $30 million on Mary Poppins last year alone. They have all these other things going for them. And I think if somebody were to invest or buy the whole company, it would probably be worth $300, $400 million.
We don't really use interest rates in DCFs. I don't think there's any reason to use them because the truth is we use what Buffett would probably use in that situation, which is opportunity cost.
Mm-hmm.
So I don't think you need to know what anything is worth. You only need to know what anything will return. And then you compare it to other things you might buy and what it will return. So when people do these calculations and say, what is something worth? I find that hard to do. It could be true that something is worth a lot. But that it's worth a lot in a world in which returns are pretty poor, if that's true. So all you really need to know is, can I make 10% a year in this thing? Okay. And then is my next best choice 8% a year? Then would I rather do this, I think that's how Buffett thinks. I don't think that you really need to know what Disney is worth. You just need to know how much you would make off of it. And whether you felt comfortable with that.
So like the actual returns that the business is generating. So basically saying like, okay, if it's at an $80 million market cap and it did 30 million last year, it's like what, 40 to 50% earnings yield today. Now, who knows if they're going to earn 30 million going forward because Mary Poppins theoretically comes out once a year.
Right. Yeah. So they weren't going to. In fact, that's why I think Buffett believed that. I think that's what I would believe about why the stock was cheap. Disney was cheap because it had a hit it wasn't going to repeat. And no one wants to be in a stock that's earnings go down. So actually, when a movie is a huge hit, a lot of investors for a movie studio, and there haven't been that many movie studios like this anymore. People aren't used to them today. The last one that was like this was DreamWorks Animation, where they're basically pure play movie studios there. So this is disguised in the big companies. The Disneys and stuff are heavily disguised. You can't really see what's going on inside Lucasfilm and Marvel and Pixar and all that. But what's happening is they have a big hit. You have, Avengers Endgame or whatever. You're not going to have another one in a year that's as big a hit. And so when that happens, that earnings will drop off. And so everyone wants to be out of the stock.
Because tough comps.
Right. So Mary Poppins, everyone wants out of the stock because Mary Poppins was a big hit. Some movies are bigger hits than other ones, So, of their earlier movies, Fantasia wasn't a really big hit. It cost a lot of money and wasn't a huge hit. But then you have another movie that comes out and, does amazing numbers. What Buffett was saying is, of course, you can keep coming out with these every 7 years or something, but that's not next year. And that's what people care about. Mm-hmm. Right?
Yeah.
So a lot of these things are very long term. And he was right in judging it very long term because almost immediately after he met Walt Disney died. And then the company was not particularly well run for, 15 years or more. But still was pretty successful in the long run. And most of the success they had after that was based on things that had happened in this period and earlier. So, even in the rebuilding the company in the 80s and on, is based a lot on things that Buffett's talking about here. They had this whole catalog that they could use. They had this brand name that was still very strong, not just in the United States, but everywhere. But that's not stuff that's going to show up next year. So a lot of people will say that they're going to have a bad next year. I don't want to be in it.
What research do you think he did?
We know some of it. He went to Disneyland. Yeah. I don't know. I mean, he was in the area anyway, but went to Disneyland. Yeah. Talked with Walt Disney.
Probably read their annual reports, knew that it was a very strong brand.
Would have read their annual reports. I mean, But at this point, Disney is hugely successful that he's talking about. That's the thing that's interesting. So you adjust it for inflation and stuff, and you're like, this is a fairly small company. It's big, but fairly small, because once adjusted for inflation, he said the market cap was, what, 80 million in this one?
Yeah, 80 million.
80 million. So adjusted for today's, I don't know exactly what that would be, but I'm guessing we're in the 500 to 700 million or something range, not much more than that. I guess small cap stock? Yeah. But in many ways, the biggest name in Hollywood at the time. So Hollywood isn't incredibly successful in the middle 1960s. Disney has already at this point won a ton of awards during that time. It might have been the most Academy Awards any one had won at that point. I don't know. During his lifetime, yeah, it could have been. Things you can compare it to, maybe Pixar. There's nothing else I can think of like that. And we know how much Pixar was valued and stuff before Walt Disney bought it. A very successful company, already having some success with some TV stuff by this point. He's right. If another movie studio got the chance to buy it, it wouldn't be at anywhere near that market cap. There's no doubt about that.
I just sometimes I wonder, like, and again, maybe
this wasn't under the radar at all, Walt Disney in the 1960s.
Yeah, it was a bargain in plain sight.
Oh, and he, at this point when he's starting up,
kind of reminds me of his Apple investment.
They already had a relationship with one of the TV networks and stuff. It was very well known. Yeah,
it reminds me of his Apple investment in a way.
Yeah,
like bargain in plain sight type of thing.
Yeah,
a lot of people were worried about Apple or China. Whenever people talk about like things to be worried about a company, they're like China.
Yeah,
whatever.
Yeah, Disney's a little different because at the time he invested in it, there wasn't a history of, can you really build a brand among kids? This is the first generation in which there's a focus on kids, the baby boomers, as a group that you could actually market to and that you could keep marketing to, that you could market to their kids. He saw that looking at it, So there was probably a sense of faddishness and stuff like that people would have had with a company like this, a sense that, they wouldn't be that... it wasn't as legitimate a movie studio as ones that put out a lot more movies for adults.
Why do you think he hasn't invested in Disney recently?
I don't know the answer to that. I don't know that Disney's been that cheap recently.
He doesn't like movie studios.
He hates the movie studio business. Yeah.
I learned that in Ted Turner.
But he owned
book.
Right, but he owned Disney. Look, we've talked about it a little bit. I think the movie production aspect for live action films is not good. I think some of that has changed if you want to count superhero movies and stuff as live action things. But they have certain similarities that are a little bit closer to animated. Animated movies have been successful with a few people who did a good job with them. But they're a different sort of business. And distribution is a successful business. But there's a problem with companies that have distribution and production needs, and there's always a problem where you will be tempted to produce more because you can distribute it and things like that. So and there was a very bad period for movies after the part that he's talking about there. So if we're talking about mid 1960s through early 1980s, it's a very bad period, lots of money being lost. Capital costs are pretty high, which is a very serious thing for the movie business. Movie business is benefits a lot from low cost capital. High interest rates are not good. High short-term interest rates in particular are very bad. So, I think the film library is very valuable, and I think he would know that. And I think that certain things you can control, certain series you can control, so animated things, taking a lot of smaller risks is hard. And a lot of them have tried to do it. They copy each other a lot. It's kind of a tough business that way, but book publishing works the same way, music publishing, video games, and they're all pretty good businesses, but individually it can be tough, yeah.
Now, it's interesting to me because that would have been a bargain in plain sight, like what you talked about. And I just wonder how many situations, everybody listening, they come across companies like that. There's a bunch of businesses that we're familiar with, right, as consumers or whatever. So whether we, use a Dell laptop, even though I guess Dell's not public, but maybe I use an Apple or I have an iPhone, or you're on your iPhone. Which
yeah,
you don't have.
Don't have, no.
Where you could really, I like Munger's approach to investing, where he's very much like he does a whole lot of nothing and then he pounces when he thinks there's opportunity. And that situation with Buffett was an opportunity where take the market price out of it, take the stock price out of it, it presented a very interesting opportunity where if Walt went directly to Warren and said, hey, I will sell you 5% of my company for $60 million, he wouldn't even think twice about it, right? And you get those opportunities in the market, or 80 million, whatever it was. So sometimes I think liquidity, stock prices, charts, everything like that, the news flow, it really makes people, think twice about things. Or let's say you trade more or invest in illiquid stocks, and all of a sudden you start to see more shares come out on the ask. And people start to say, well, who's selling? Who's selling that knows stuff?
Sure.
So I have, talking a little bit about that, I pulled the first 8 things that you look for or look at when researching a stock.
Okay.
And you said the first thing you do, and I wonder if this has changed, right?
All right. This will be the title of the video, the podcast episode.
No, we're going to talk. No, it'll be Disney. It's kind of more free form, right? So this is from 2017. You said the first thing you do is check long-term stock performance. Like, what is the annual return in the stock over 20, 30, or 40 years? So Buffett in that situation, right? Maybe he's not checking the long-term, stock performance, but I'm sure Disney has done okay. I'm not sure. But it's a business that he has definitely known.
Disney had been public for a while by that point, yeah. It had done well. It was known as a successful business. Yeah. It'd always been short of capital. That was its big risk. Walt was crazy about spending tons of money, and they had to keep borrowing more and more money to do it. Everything they did was a little bit bigger than before, but it was a very successful business, yeah.
But it's all about just finding all of the historical data that you possibly can on the company.
Yeah, that's very important there. I mean, you don't want to just think, he knew that. You don't want to just be like, was this Mary Poppins thing a success? Okay, good. You want to have it's very different if there's been 10 Marvel movies and now you can evaluate the value of the franchise than if there have been 2 that were both originals and you have no idea what the sequels are going to do. He had a good idea of what a Disney movie was, and, so yeah, you need a long history that way.
I just wonder, because I'm getting all these emails and I see all these tweets, right? People that listen to the podcast, and I just think a lot of people, if they almost simplified their investment approach, they could dramatically improve their returns. And that's kind of
maybe in some market eventually, but not right now.
What do you mean? Right now? Not right now?
No, I mean, not right now. That you don't need to make these adjustments. These adjustments aren't going to help you do better right now.
No, of course not.
Because those things are not going to matter so much in a market that's the way that it is today. Yeah. So, but a lot of these things are similar to how I would have looked at it back then. It was a little harder to get charts that long back then. So that's a more recent thing. You didn't have 10, 20, 30-year charts in the 1990s. Actually, you had no long-term charts yet at first.
I mean, it's like his whole thing is like invest in what you know, right? Okay. If you look at a lot of his portfolio, it's a lot of things that he does know, things he likes.
Yep.
He's always liked trains. He's always likes candy, Coca-Cola, stuff like that. So I don't know. Sometimes I just think
some people invest in what they know. Sure.
But I just think sometimes there could be a great strategy behind waiting for those fat pitches that do happen in the market.
Yes.
Where you have those companies that that very well are very dominant, and then all of a sudden the market gives you a very opportune time. And it's back to what you were talking about, really approaching the Mr. Market as he's there to serve you.
Yeah. Well, I mean, but the thing with Buffett is he could go a few years without buying something. Mm-hmm. I mean, even if you look at what he owned in Berkshire in the early days and stuff, there's not a huge amount of turnover and stuff. It's tough. For most people, their problem is going to be that they want more. I mean, Buffett spends an incredible amount of time thinking about investing, and takes very few actions. The average person is going to want to take a lot more actions and spend a lot less time thinking about it.
Is that because of liquidity?
No, I think it's an action bias. I just think I think it's true in gambling. I don't think anyone wants to think about what bet to make for 30 minutes and then make one bet. I think they'd rather make 30 bets, based on instinct and stuff like that. They want hands to move faster, things like that. I think it's more enjoyable for people.
Yeah, I mean, you look at Munger's portfolio, and he owns 3 stocks, right? What he calls 3 stocks. Lee Lu's Fund, Costco, and Berkshire Hathaway.
Yeah, and I mean, I can even think of things that Buffett's done and stuff where, if anything, he's maybe had a little more turnover than he should have in some cases, that he would have done better sticking with some decisions that he made that were big decisions rather than making a few small decisions.
If you just held Disney.
Yeah, if you just held Disney, it would have done pretty well. Although Berkshire, I did the calculation one time and stuff. He would have done pretty well in Disney and American Express, but he did even better in Berkshire in those years because Berkshire had a very good run. And I believe he bought some Disney for Berkshire too, actually, in the early days of Berkshire. I'm pretty sure he did, but not a ton. Yeah, it certainly would have done well, although, The business had a rough decade and a half or so after where he bought in, but was very successful afterwards. Yeah.
I don't know. It's just if you were to run your own personal portfolio, and I think a lot of people that listen, they are individual investors, so they have the benefit of doing that. I just think there's such a advantage for those individuals where you're not constantly having to find new ideas if you're constantly getting new capital. But if you get new capital ever, you could always buy more of the company that you own or already own. But that's very hard for people to do.
You sit on cash. I mean, my guess is I don't think Buffett really took money in and then used it to buy the same stuff he'd been buying before. I think he bought new stuff with it or held cash, until he came up with another good idea. I mean, Buffett's big successes, his home runs, are in a smaller number of industries that he knew pretty well and thought about a lot. And I do think that most people could benefit from that, focusing in on a few things and taking actions more rarely. The problem is, like I said, there are long periods of time where there's nothing to do in a certain area. So let's say you spend a lot of time thinking about insurance or banking or something. There are actually sometimes a few years where there's not really a lot of good choices. What are you going to do in banking in 2006 and 2007? Where everything's going well, in like backwards looking results, if you're looking at the trailing 12 months, all the stocks are pretty expensive, and they've made a lot of loans that probably aren't that great, or even if they didn't make them, their competitors made them, and there's not a lot of smart things that you can do. Energy stuff. Okay, you spend a lifetime thinking about like oil and gas and stuff, but when it's at $100 a barrel, what do you do? You see that with Buffett's things. I mean, he made a bunch of investments in newspapers and things like that, but he made them in kind of particular times. There'd be a few years where you could make them, and then a lot of years where you couldn't. So that's the problem with learning about any sort of industry that way. That there's, the opportunities come in clumps in a short period of time.
Do you think he would like theme parks today, like Cedar Fair?
He's never shown an interest in
Six
theme
Flags, SeaWorld.
No, he's never shown interest in those things. It's interesting because he's talked about Disney and his interest in that. And at the time, Disney was two things. It was a movie studio and it was theme parks. And he hasn't really bought into movie studios or theme parks. So,
yeah, because I was looking, I think Six Flags, if you purchase Six Flags pre-pandemic, and you held all the way to today, I think you would actually be up on your investment.
That is the disturbing thing, right? Lately, the pandemic reopening type things and how far they've regained in a lot of these, right? Mm-hmm. So I talked about some companies that wrote up some companies like Marcus, there's theaters and also hotels, and some companies like that. And the recovery has been so big in such a short period of time when there's been no recovery in the business at all. So, the problem is all these companies are going to have more debt. Mm-hmm. Some of them, Marcus can sell some things off, some excess assets and stuff like that. But this does create a one-time permanent hit. I expect cruise lines to do fine in terms of generating good returns in the future, their margins and things like that, the occupancy that they have. However, their capital structure has changed a bit in that they had that one-time loss has put debt on their balance sheet that they will have in the future, and so they are actually more expensive than they were before. This hit does stay with the company, even though it's only a one-time thing, not repeating.
I just wonder, do you think there's a good spot for sort of the reopening, like the rebound stocks?
I don't see it. I mean,
I know at one point you said
I wrote them up before, yeah.
Yeah, you'd be potentially interested in, either movie theaters, or you could play the cruise lines by buying Leaps and Carnival.
And I thought that then. There was a different price then, though. I mean, you can go back and listen to when we were talking about those things. There's a reason I wrote up Marcus when I did, and when we write it up now, I think. I mean, I don't know. Do you have the most recent chart on that?
No.
So
we could go 1 year.
Yeah, so it was in the $8 to $10 range. Right? Mm-hmm. Yeah, for a little while there. And look, the truth is the business has deteriorated, in my view, since that time period.
Yeah.
I think some things have changed, which permanently harm the movie industry as compared to what it was before. I don't think that had happened by that point. And so I think the stock has gone nowhere but up. during a period in which actually the economics of the business may be harmed a little bit.
Not only that, but I mean, you're also, if you're going to buy Marcus, you're going to make a bet on business travel.
Marcus Hotels. That's a problem there.
Yeah.
And so it's not that I think, I mean, look at their stock today. So what was the last, let's go back in time. Where were they? Do you have a longer term chart that you can do there? What level were they at? Okay, so they're back at a level that they were at on the way up. If you look there, you can see that was
2016 area.
Yeah. So do we really think that movie theaters and business travel focused hotels are worth as much today as they were in 2016? I don't. So it's much more expensive. But people can look at that and say, look how cheap it is versus the high that it had. Mm-hmm. Cinemark is just movie theaters. So that's a little different. But I think there have been some change. I don't want to overstate it. I don't think it's like airlines. But I think there have been some changes in the movie business because of how long people's behavior has had to change. And so that will change things in the same way that it will change demand for office space and things like that.
So you really think Cinemark in the future is going to have a more challenging time?
Yeah.
That's the first time you've said that. On the podcast, at least.
I'm more uncertain. Mm-hmm. Yeah. Well, more challenging, I don't know. I mean, some movie theaters will go out of business. So that'll be a different story that way. But people could have changed some of their behavior. Now, some of it will be positive. They may be able to use less labor. They may be able to have people order more in-app, get things themselves, concessions right then. Marcus certainly experimented with that. Some other companies have. I think they can drive more higher spending on concessions without using labor. And controlling more of it inside their app and inside their membership programs and stuff, I think will increase because of COVID. People got used to doing that kind of thing during COVID. But no, I think that office space, I think that airline travel, I think that hotels that are based on business travel, I think movie theaters will be affected. And I think they'll be affected long term because of changes in behavior that makes them less certain now than they were before. I think all of that is more of a risk than, say, for example, brick and mortar retail. I don't think will be as affected because I don't think people understood there was Amazon before. Mm-hmm. You didn't introduce a different idea of how to do that. But the idea of watching movies at home that are new movies and of finding different things to spend your time on is a change. The biggest change, I think, is office space and business travel. Because businesses don't experiment with that, and this is kind of a forced experiment. They don't run an A and B test on that, but they kind of were forced to see it, and so they now know if some of their spending on office space doesn't matter, some of their business travel doesn't matter. But yeah, I think the recovery is too much in these businesses. Yeah.
Why do you think Buffett has never bought into a theater company? It seems like his, typical type of company.
They're a better business now than they were 20 years ago. So through a long period of his investment time, they weren't that great businesses.
It's been a lot of consolidation.
They were too aggressive, using a lot of leases, things like that. It has similarities to the gym business in terms of what happens and how over expansion goes. I've been interested in the movie theater business because of the consolidation and the rationality of some of the groups and what they're spending on, improving the experience, trying to up the amount of spending per person. I think is very attractive. Mm-hmm. I don't think you have to grow the movie-going audience. I think it can shrink by quite a bit, and you can still make more money over time because you can shrink the number of locations and because you can up the total spend, the gross profit per person that you get on a combination of concessions and tickets. I mean, it's an interesting business because you have a group of people, millions of people every year, every week, when it's not COVID, who are willing to go out in whatever weather there is to a place that's pretty far distant in some cases from their home and make an event of it. Mm-hmm. So the potential to make a lot of money off of them is big. I mean, the monetizable potential of movie theaters is really big. They are groups of people who want to be fed, who want to be entertained, who want to spend a few hours out. I mean, that's a really big opportunity. And so I think that you don't have a problem if your attendance goes down a little bit over time because the number of locations can go down over time, and because I think there's a lot of potential to make more money in different places, whether it's selling alcohol, whether it's selling more convenient type things for them, for higher quality food. Eventually there you will sell merchandise there at some places. You'll use some of your floor space for that. You'll use some of your floor space for virtual reality, for arcades, for whatever other things happen to be popular at that moment. And you can compete with those things. So I think, movie theaters, I think, over time, if they've been given enough time to make this change, would be in a good position. What worries me about movie theaters is not like people not going to them and stuff. What's always worried me is the bargaining power between the movie theaters and the studios, and what their interests are. And their interests aren't 100% aligned. What makes the most money for a theater is not exactly necessarily what makes the most money for that movie. And maximizing the potential revenue of the movie, is a little different. So that's always been a concern. I think movie studios do understand, though, that the way to maximize revenue of a movie is to have some theatrical run. And I think they know that even now. They've seen that. And I don't know, I think some of the stories I've been told about things, like I've seen some things where they say that they've made as much money from releasing a movie without, in a couple cases, without it being running in theaters and stuff. I don't think they're doing the calculations correctly.
Are you saying like over streaming it? Like streaming it as opposed to releasing it in the movie theaters?
Yes. So in some cases, what people said, so for example, there was some stuff like DreamWorks as an example through Universal. They said that they made more money, or they made the same amount of money, because they get 100% of the revenue if you watch it through their streaming platform and pay for it, whereas they would only get about 50% of the revenue if it played in a theater. Okay. The problem with that calculation, though, is a few things. Number one with that one is, they released a movie, a sequel to something, when no one else was releasing stuff. So this is a very big factor in the COVID things, where people think, they didn't release it into the same landscape that they had. And that's where you want to be careful. I think the studios understand that, but I don't know that the people writing about it understand that. That if you have a world in which you don't put out any really attractive movies, and then you put out a movie that people really want to see, it will do huge numbers. A major reason that limits how much movies make, especially in theaters, is the other alternatives.
Sure.
And there's a lot of things about COVID that people don't realize with that. Like, why did people do so much of this thing or that thing? It's because they didn't have any alternatives. You get rid of those alternatives. I mean, we could talk about that more with the macroeconomy, but that's one of the concerns with the macroeconomy is people do this calculation of here's where the economy is, and it's below what it was before. It's below what it was before with certain things shut down.
Yeah.
So you have to make the assumption that people will switch from what they're doing now to the things they're not allowed to do, or can't really do the way they want to. Mm-hmm. But if you just start up those things that they're not doing right now, and also kept all the things that people are spending money on right now, then your economy would be way beyond what it was before COVID hit. Same sort of thing. So it's a trade-off between them. A major reason why people watch certain movies was because they were the only options out there. A lot of movies were pushed. A huge number were pushed.
I just wonder what is going to severely bounce back post-COVID, which we're, I guess, basically already there, right? But I guess everyone having the vaccine, everything opening up again. What's going to bounce back? What's going to be something new where, maybe we're not going to travel a lot? Like, what's the world going to look like?
I mean, my feeling is cruises.
Because now, we're talking about like competing against, for some companies, really strong comps because maybe they benefited from COVID, right?
Yes.
So some people could look at that, like, the trade's already over, for example. What's going to bounce back? What's going to be strengthened? What's going to continue in the future? So you think cruises will bounce back pretty quickly?
I don't know about quickly, but I think cruises are one of the ones where I think I don't think anything has happened that will change people's behavior regarding cruises, whereas I think it has in other areas. I think people will be hungry to have people who love cruises, and it's a small group of people who do a lot of them, have been starved for it now for what will be a couple of years, and it will be a kind of experience that they haven't had before, and so it'll be something that they're interested in. They lost a lot of money, though, during the during COVID, and they're going to be carrying more debt because of that. And the stock price has recovered quite a bit already. I mean, some of these stocks have recovered a lot. So I'm not necessarily saying that the stocks look all that attractive to me. But I am going to say that I expect that when it does happen, that people can cruise regularly again. That the amount of bookings you'll see and stuff is going to surprise some people. And there'll probably be articles written about, isn't this insane? Why are people doing this and stuff? Because they would think that cruises would be the thing that people would be least interested in doing.
Yeah.
But I don't think so. I think the things that change are when you have the risk to business is when what you never want people to do is be able to trial the alternative, right? So like if you had a toothpaste brand or something, and what could it spend the most advertising on, stuff that it would want to do? The thing it would want to do is to try to convince people to never try the other brand. If we could just get you not to see that the other brand might be somewhat comparable and stuff, what the alternative could be. So that more than anything is what's most important. That's the problem that I see with office space and business travel. No one would have tried to see exactly. I mean, it's too big a risk to try this out on your own. But every company ran the experiment.
They were forced to.
Right. Basically, everyone ran the experiment on movie theaters, and it's my concern because the studios never would have run an experiment where they release things the same time as Warner Brothers has done, release things the same time in theaters and on their app. They never would have done that, and now they did, and they've done it for a bunch of movies. They're getting a lot of data on it, so it's a big concern, and that also changes things. Remember, without those apps and things, studios have limited data as compared to movie theaters. Movie theaters have these loyalty programs and things and have a lot more data on people. So it's a big difference.
And then you take it to Carnival. What's the alternative? Not traveling.
Right.
Or not taking a vacation via cruise ship.
Yeah.
A little bit different than a movie theater.
And I think people will want that back. And in the long run, this may slow down fleet growth and stuff like that. I'm not saying that they're attractive stocks right now, though. I don't want to say that because they're not that cheap compared to what they were in the bottom of the recession and of the COVID, shutdown for cruise lines. But it's the kind of thing that I expect will be more like what people were expecting, where it's like it shuts down and then it opens back up, and it's a temporary thing, a total shutdown, and then you return to levels that you had before. I mean, at first, I expect it to be higher than levels that we had before. I think that cruise lines at first will report that they're booked through for long periods of time, and especially for certain kinds of things, like really long trips and stuff like that. They're going to say, the really long cruises and stuff were completely booked and all that, and that may surprise people. But I think that will happen. When they talk about pent-up demand, I think there'll be a lot of pent-up demand specifically for cruising. Whereas some of the other businesses, I don't know. It's a little more complicated, and we'll see what it's like. I mean, there'll certainly be some for a while with movie theaters and things, people wanting to go out and see that. But there's just more testing of that that could change it, and that's what worries me.
And you think business travel for like hotels is going to be challenging?
Yeah, I mean, all these things have this problem where a hotel lasts forever. A cruise ship lasts for decades. So if you decrease demand by a bit, then you probably didn't decrease supply fast enough for that, And my feeling is that for some of these hotels, for instance, we'll take hotels, and for airlines, they were set up to make money on business travel, and that subsidized to some extent everything else that they were doing. So there's lots of hotels where, although a lot of people in their hotel aren't groups and things like that, without the corporate business, they wouldn't really be making much money. So I think that will be a problem, and will take a few years. And that's what we've seen before too, is consumer recovers faster than business, in recessions like that. And so I would expect the same sort of thing. I do think that, yes, I mean, I think cruise lines will recover, like use of cruises will recover much more so than business travel and airlines and hotels. Yeah, definitely.
Got it. I really wonder why Buffett, it's surprising me that he hasn't bought more Disney through the years, or theme parks in general. Maybe the more modern theme parks, they're very capital intensive.
I don't know. He doesn't
really talk much about them either. I've gone through the Buffett FAQ I have, or everything he's ever read or
never talked about them.
Nothing. No.
Not a big entertainment person. In terms of his investments, I would say. So, I say both movie studios and theme parks that way. It could. I don't know what it is. If it's concern about people's changing habits and things like that, I don't know. He gives McDonald's as an example for things, but then doesn't really invest in food things that way, restaurants and fast food and stuff like that historically. So there's certain industries he talks about sometimes and doesn't do a lot with that way. Disney, though, he put a lot of his fund into and everything. So at one time, he did like it a lot in the 60s.
He seems to like things where people use it every single day, habitually. So, Coca-Cola, for example, Amex, slide in the card.
It's true, and you don't do that with Disney.
Gillette.
Yeah.
Shave every day.
Right. I think Disney is a different...
Because people have more choices. Do you want to go Disney World or do you want to...
That's true, but here's the problem.
Go to the ball game.
You could say that, yeah. But here's the thing. He owns See's, which is a once-a-year purchase, basically. A gifted one. He could buy any candy business. He could have bought any candy business that people actually consume all the time. It's a totally different business, the candy business of what people buy at convenience stores and stuff to eat themselves versus what they gift once or twice a year. Mm-hmm. He bought the one that they gift a couple times a year. I think that things like Disney have a brand that's very powerful, even though we're talking about things that are, in a sense, not habitual. I've said that before with things, whether it's their theme parks or things, whether it's Marvel or Pixar or Disney branded things, that it has a brand that stands for something for the minds of some people. And that it's not really the fact that it's not habitual isn't a problem. I think that the durability of like their theme parks or something is big and more durable than a lot of businesses that are regular, frequent purchases. I'd have more faith in that than a razor brand today. That Disney will be doing certain attendance numbers at its theme parks in 10 or 20 years, sure. Mm-hmm. Even though it's a once every some number of years for most people. It's not even a yearly thing to be able to go to a Disney theme park. But the idea of it, I think, means something that it doesn't in other ones in the industry. Disney's a little weird that way. It has pretty strong brands in areas that are fairly non-branded. There's little awareness from the general public of what studio's putting out a movie, but they know what a Disney movie is. There's little awareness of like theme parks. Basically, it's whatever is the one you can get to. I mean, sure, that's why if you ask people what theme park they go to and stuff, as a kid, it's like where they grew up. This is what was there. It's not, oh yeah, I go to all the Six Flags parks around the country or, things like that. But Disney has a special name for itself that way.
That would be one of my questions if I were to have lunch with him.
Okay.
It would be, why haven't you ever invested more in theme parks, and his thoughts towards that. I'm kind of curious to hear if you were, that's one of my questions. Okay. If you were to have, let's say you won the lunch auction, so you paid whatever it's up to now, probably $3 million, right? What are some questions you would ask him?
I don't know. I've never wanted to do that or thought about that or anything like that. When people talk about what would you ask, I have no idea. Yeah.
That'd be kind of fun to see.
I mean, you could ask questions about things that you weren't sure about from the past, I guess. He chose not to invest in Disney stock when Cap Cities did the merger. He could have just kept it all, kept stock and done that and continued to own Disney. He chose not to. But that was also TV networks. There's other things in there too besides that, because it would already merge with ABC. Cap Cities ABC was what was merging into it at the time. I mean, my thought on that one, I think I've said before, is I don't know if he would have done it because of Eisner at that point, how far along it was with Eisner and what was happening, but maybe I'm wrong.
He didn't like movie studios. In the Ted Turner book, when they were talking about he was going to have a meeting with Buffett and whoever Ted Turner was with, I forget who it was, but he said...
whoever Ted Turner was with, but it was... Turner might have been there with... I forget if it was Malone, but anyway, it was definitely Murphy and Buffett together.
Murphy and Buffett, yeah.
Yeah.
I think Murphy, who was? Somebody told Ted, whatever you do, don't talk about wanting to start a movie studio or
Well, he wanted to buy a movie studio, yeah. And so, and Ted Turner was pretty aggressive with those sorts of things. I'm sure Buffett didn't want someone to be buying in a bidding war a movie studio. I'm sure he liked movie studios less than any other business at that time. And I do want to point out, this was a period that was some of the worst times for movie studios. The middle part of the century was a time that was really hard for them. The last 25 years has been better than the, let's say, 30 or so years before then. And he was talking about it in that period.
And he said the meeting went well until he told them that he would want to buy a movie studio. He said Buffett just kind of is like right there, it was done.
No, he didn't want to be involved with that. Sure. And it's completely changing what the company was. I mean, you read the Turner book, so he would do that all the time, where he would completely
Ted, yeah, he was a bit crazy.
go in a different direction that way, right?
He's my type of crazy.
So someone would be investing in the company, right, thinking they're buying into UHF stations or whatever, and then it's okay, now we're a superstation doing all this stuff, so now we're some sort of cable company, but then bought professional teams, right? So you'd be in that business, which you hadn't expected at first. Then you'd be invested. Then you'd be trying to take over a movie studio and all of that went on. Then you'd be launching 24-hour news network.
Yeah.
All those kinds of things. And he was doing that constantly. Some of his success came from ending up with a board that actually stopped him from doing anything. He had to basically give up significant control of the rest of the cable industry, and some of that was a pretty successful period. I don't know if he would have been successful without it. The things he bought up and stuff did do really well, but they were going to consume a lot of cash and everything, and he was going to keep having to come up with more financing, whether it was issuing a lot of bonds or what he was going to do. He had a ton of success with the things that he did, but he may have run a little ahead of himself on that without that board. He may have used debt a little too much, and things that were starting up would lose money at first for a while. I don't think Buffett and Turner would have been a good combination.
No. Yeah, it seems like the exact opposite of somebody that Buffett talks about wanting to invest with.
Yeah, and if you want to see about the movie studios not being a good business and everything, read Curse of the Mogul, right?
Which one?
Bruce Greenwald, Curse of the Mogul.
Oh, I haven't read that.
Is it Bruce Greenwald and Jonathan Nee?
The professor?
Like yeah.
Yeah, no, I haven't read that.
Oh, yeah. So you should, I guess, read that one. It's a little bit like the, like his value investing, Buffett, Graham Buffett and all that, because it has some, I don't know, it's a little bit more formal, I guess you could say. But sort of the idea that people have of, all these media moguls and stuff, did they really create value and all that? But you could also just read the books. I mean, you can read a couple books about Murdoch, a couple books about Turner and Sumner Redstone and whoever else that way, and see which ones you think create a lot of value. It's a very mixed bag. A lot of them keep buying things even when it doesn't make sense and all of that. And so it's interesting to see. I think the actual movie studio business is not as bad a business as it gets a reputation for. I think some of the stuff attached to it is not necessarily that good, and there's a temptation, if you have a movie studio for various reasons with economies of scale and stuff, to do too much. There's a very strong tendency in that Hollywood's gone better at, but there had for a very long time been a strong tendency to produce too many movies. And I think that comes in part from having distribution and production tied to each other and some stuff like that, because you want to have a certain, and they'll even say how many movies they want to put out a year and stuff. And really, that's not the best way to do it. Just like with an insurance company or something, it's not best to be like, we're going to write $1 billion in premiums, whether people want it or not, whatever price it'll end up being priced at. Yikes. So if Paramount says we're going to do 12 movies or something, then they're going to try to, you have to do that, and you have to plan a few years in advance to do that. And so sometimes you end up putting out too many movies. And there were periods where they did. They've cut back on that. The major studios have, if you look at movies released by the major studios, it's been a number that's been trending down for a long time now. They've been strongly under 100 movies released by major studios on average for a very long time now, whereas on average,
the price per movie created, though, has gone up, too.
Yep. But maybe that's a better model.
Yeah.
To do that. Mm-hmm. There's reasons why I think that might make a little more sense. Now, there's actually a ton of movies because independent studios and stuff release things that aren't counted in what I just said. But, making fewer... And there's just a lot fewer movies that aren't based on some pre-existing material. There's more sequels. There's more lots of things that way. But, you have those libraries from this, which is with the Turner things and stuff we were talking about, with the Disney things. I mean, that's the thing about Disney Plus, right? A huge part of it, is the stuff that Buffett's talking about, that just having that library over all the time, never selling it off and everything, allowed them to move into an internet thing. They never had to imagine what it would be. They just know that people want that content.
Which all stems from what? Their brand.
Yeah. And Turner created a channel, Turner Classic Movies, which is like 50 to 70 years later than when most of the movies on it were created, probably is when he launched the channel. So no one ever envisioned a cable channel Everyone they didn't even envision video cassette inside the time. They just thought you'd run a movie and then no one would ever see it again.
Yeah.
And then it had a life that much longer afterwards because of creating content that people want to see. You know, we've talked about that before, but that is something with all of these sorts of things. If you have content that people want, then there's a lot of value in it, even if it's just selling it to Netflix and all of those sorts of things, if you don't have a way to get it yourself. The advantage of things like Disney and those kinds of things is they have pretty broad portfolios of brands built up over time through these mergers. Same thing with Warner Brothers, right? So they have a portfolio that they can work with. So you've got HBO in the same thing that also has Warner Brothers stuff, and that helps protect them. You know, DC and other Warner Brothers films together with things that people would want to watch with HBO and all of that. You know, and a few companies don't have as much of that. You know, even like we said, like CBS, Paramount, which is the same company.
What about Lionsgate?
Yeah, I mean Lionsgate's. I don't know if they use the term now, but historically the term used was mini major, right? So it does have that problem where it's right on the cusp there. If you want to, that's the idea of here's a movie studio that might have insufficient scale, right? But that's a good example because I guess Lionsgate was public at the same time that DreamWorks Animation were public, and both of them would have fallen in that same category. They occasionally had a movie that was a top movie of the year. You know, if you looked at a list of top 20 movies or something, you'd see a DreamWorks Animation movie or a Lionsgate movie. But clearly the average of their box office and stuff did not put them in the category of a major studio.
When I think Lionsgate, I always think like horror.
Well, it depends on because of what they put their name on, right? Yeah, so that's the problem. Yeah.
I think like Saw. You ever seen those movies?
Yeah.
I think that was
so there you go. That they put their name on.
Graphic, terrifying.
Yeah, so they put their name on those sorts of things. Absolutely. Yeah.
They're making a push to streaming as well. I think they have their own app.
Yeah, and they're all going to do that. We'll see what people do with what things they sign up for. I wouldn't be surprised if people sign up for a lot of different choices that way.
Yeah.
But the things they might think of first, of course, are the ones that have a little bit broader portfolio. I mean, you know, Disney's in a really strong position, and then maybe Warner.
I haven't watched The Office in a couple months. Before it was just habitual. I just put it on when it was on Netflix.
Because it got moved to, and you haven't embraced Peacock or whatever.
I haven't signed up for it yet, no.
Is that the name of what they're doing?
I believe so,
Universal? Yeah. But that's something. So Universal does own DreamWorks Animation. They shut down some other animation stuff that they owned. They will have that. They did, you know, I don't know. Universal maybe is more in the Paramount category, to be honest, but we'll see. I mean, I think Disney is ahead of everyone,
of course,
on that. Yeah. But I think that Warner is strong, you know, so that having HBO and DC and all the Warner Brothers things under one thing makes like HBO Max or whatever they choose to put things out on a very strong position for them too. And especially like globally, which is the other thing that Disney and HBO both have, is they're pretty strong around the world, which isn't as true for some other ones. But, I mean, people might subscribe to any of those. They might have hits at times from them. But I do expect them to be more Netflix, Hulu, Amazon, and some of the names of the biggest studios we just talked about. You know, and we have talked a little bit about the fact that maybe the antitrust stuff has changed now so that you could have a movie theater owned by someone who is involved in making movies. But my guess is if that happens, it won't be the major studios. It will be the ones who've kind of not had success. It'll be Amazon and Netflix.
AMC or something.
Yeah, Amazon and Netflix would be the ones that would be most logical to want to be in those businesses probably. And I don't know if they do, but one issue is they don't have, remember those things don't have, like I said before, data, right? So they don't have data at the point of people watching the movies in a movie theater. They have huge amounts of that data for themselves online. And that's one of the things. And then the other thing is distribution. But anyway, those haven't worked out that well. I would have guessed that Netflix and actually making movies and Amazon making movies would have done better by this point, and they haven't done that well. They haven't had a lot of success in production.
Why is that? Amazon has more firepower.
Almost all
than
internet
any
companies
company.
have had terrible times trying to produce movies. I mean, I've read a bunch of books recently about internet companies, and it's amazing how every one of them tried to have Hollywood produce some content for them instead of just like doing a production deal with someone to do an output agreement, right? Mm-hmm. It's not the business they're in. They're not creative people. I don't know.
But like Amazon, they could build a whole, unit at their company and hire whoever they want.
I wouldn't do it. I think it's better for them to do an output agreement with someone that's already existing. So to find someone and have them put all their movies with them or TV shows and things, make it for them, cost plus type agreement or something.
I mean, Amazon's really making a push. I was reading to, like exclusivity for NFL games and stuff.
Yeah. So that's something to do. Maybe they feel that will work for them. I don't know. I mean, they have a weird thing that I'm not sure that there's a lot of things. I mean, I think Amazon pursued the idea of having, trying to win awards, which I don't think is a good match for them. And then I think the things that actually drove engagement with Prime, actually converted people to subscription on Prime and stuff, were totally different content. I've mentioned before, I think like the Grand Tour, which they got, which is basically a redo of something that had been on the BBC. But the people have been like fired and stuff. They just agreed to take on these controversial personalities and do the show again. And, so you're cloning what was already there. And I think that is something that probably was successful for them. But that's the opposite of award-winning whatever kind of stuff. That's kind of dumb reality type stuff. Personality-driven, things like that, which might make more sense. Yeah, would it be good if you got a Joe Rogan or Howard Stern or whatever things like that might work. But you have to think about that. They decided they wanted to win Academy Awards, and they did.
Yeah.
They can win Emmys and Academy Awards and stuff, but I don't know that that's the best fit with their company. If you spend enough money, anyone can win Academy Awards and Emmys. I mean, because you can, the creative people will work for whoever pays them a lot of money. So you can finance a movie, and
sure.
People, if you're willing to pay more than anyone else.
I can't even name one that they've won one for. Can you?
Amazon?
Yeah.
Yeah. So do you know Manchester by the Sea? That's
No.
an example of the kind. It's an example of the kind of movies that Amazon has made. Yeah. Yeah.
Interesting.
They've done some things with some others. I'm being unfair in that they've done some things that are a little more commercial and stuff. But I would have said they should have gone in a much more commercial direction.
How long until Amazon buys or Jeff Bezos buys an NFL team?
That's a good question. Who knows? Yeah. I mean, he won't be Amazon anymore, right?
It's just the chairman, correct?
Yeah. So, yeah, we've talked about that before, that he was transitioning to doing other stuff.
Blue Origin and other things.
I mean, maybe COVID changed that for a little while. That's my guess, probably.
What do you mean?
That he was briefly re-engaged with Amazon more than he would normally be. Yeah.
Yeah, they said that he wasn't really around the office much
and also just like
prior to COVID.
And with COVID, there was a lot of Amazon was very important to the country, and there was a lot of negative publicity for Amazon and all that at the same time. Yeah.
Crazy. I don't even know what the title of this podcast, but I hope that you enjoyed all 1 hour of it. Thank you so much to everybody for tuning in with the both of us. Make sure you hit that subscribe button both on YouTube and the podcast side of things, and we will see you in the next podcast.